Picture this. It's late November 2001. Buenos Aires. You're 42 years old, standing inside your bank branch at 9:12 a.m., withdrawal slip in hand. You've run your grocery store for 17 years. For a decade, 1 peso has equaled $1, 1 to 1. 10 years of sameness. You have 18,400 pesos in your account. You need 3,000 today. Suppliers raised prices again, cooking oil up 12% in 2 weeks. Imported flour now priced in dollars only. They want cash within 48 hours. The newspaper folded under your arm shows a small headline. Reserves fall below $20 billion. On the radio this morning, a rumor. Banks are short on physical dollars. Transfers are fine. Cash is tight. The teller types your account number. Pauses. There's a restriction. You stare at her. 250 pesos per week. You do the math. 3,000 divided by 250. 12 weeks. 3 months. Rent is due in 10 days. Payroll in 6. Your suppliers won't wait 90. Behind you, someone says dollars are disappearing from ATMs across the city. A man in line mutters that his transfer to Miami hasn't cleared. Another says the central bank lost $3 billion in a month. 10 years of stability. 3 days of rumors. 1 signature from the government. You have 18,400 pesos. You can touch 250. The arithmetic isn't loud. It's tightening, and it doesn't reverse. In this video, we're breaking down the 4 structural stages every collapsing currency passes through. Not headlines, not personalities, not ideology, structure. Stage 1 is artificial stability, a fixed exchange rate or policy anchor that suppresses volatility and manufactures credibility while pressure accumulates beneath it. Capital flows in. Risk premiums compress. The surface looks calm. Stability isn't strength. Stage 2 is structural imbalance. Debt expands faster than output, fiscal deficits widen, reserves thin, and external vulnerability increases. The arithmetic shifts quietly. Incentives begin to distort. The math doesn't negotiate. Historically, fiat systems measured in decades, not centuries, eventually confront this arithmetic. Stage 3 is liquidity restriction, when confidence weakens and access changes. Withdrawal limits, capital controls, banking freezes. Not because currency units disappear, but because the system cannot meet simultaneous claims. Liquidity is rationed. Access becomes conditional. Stage 4 is forced reset. The policy anchor breaks, the exchange rate reprices, and purchasing power adjusts downward. Devaluation transfers losses. Inflation absorbs excess claims. Savings become the adjustment mechanism. The reset is not neutral. It redistributes balance sheet damage. Different jurisdictions, same sequence. Once Stage 1 is installed, the terminal adjustment is a function of accumulated imbalances. Argentina's collapse did not begin with panic. It began with a rule. In 1991, the convertibility plan locked the peso to the US dollar at a strict 1-to-1 rate. 1 peso equaled $1 by law. Under a currency board, every peso issued had to be backed by dollar reserves held by the central bank. No discretion, no exchange rate drift. After the hyperinflation of the 1980s, this rule restored confidence almost immediately. Inflation collapsed. Contracts stabilized. Capital returned. International lenders extended credit at lower spreads. Deposits flowed into banks. Growth resumed. The number 1-to-1 became psychological infrastructure. But the peg did more than reduce inflation. It rewired incentives. When you fix your currency to a stronger one, you remove exchange rate risk from the surface of the system. Investors see predictability. Borrowers see stability. Households see permanence. The cost of borrowing in dollars falls because the exchange rate appears guaranteed. So, balance sheets adjust. Corporations borrow in dollars. The government borrows in dollars. Banks expand dollar liabilities. If 1 peso equals $1, foreign currency debt looks interchangeable with domestic debt. The distinction feels cosmetic, but it isn't. Under a currency board, monetary expansion is not autonomous. The domestic money supply can only grow if foreign reserves grow. Liquidity depends on external inflows, trade surpluses, or capital investment. If dollars enter the country, pesos can be issued. If dollars stop entering, peso expansion stops automatically. The system cannot self-stabilize. It must import stability. At first, this constraint increases credibility. Markets believe the government cannot inflate away its obligations because it has surrendered that option. Discipline appears embedded, and capital responds. During the 1990s, privatizations and reform programs attracted significant foreign inflows. Dollars entered. Reserves accumulated. The money supply expanded in tandem. Consumption rose. Credit deepened. The peg held. But competitiveness began to erode. As the U.S. dollar strengthened globally, Argentina's currency strengthened with it. Export prices rose relative to trading partners. Imports became cheaper. Trade deficits widened. Domestic producers faced compression. The exchange rate did not move, so the adjustment migrated. If exports weaken and imports rise, foreign currency must still fund the gap. That funding comes from borrowing. Public and private external debt began to climb steadily through the decade. Debt ratios increased. The peg remained fixed. This is where the contradiction hardens. A fixed exchange rate requires credibility. Credibility requires reserves. Reserves require inflows. Inflows require confidence. Debt growth makes confidence more fragile. The stronger the commitment to the peg, the more the system depends on continuous external financing. And the more external financing it requires, the more sensitive it becomes to shifts in investor perception. Pressure is not released through currency depreciation. It accumulates in liabilities. Throughout the decade, Argentina's fiscal position remained structurally weak. Government spending exceeded revenue in multiple years. Provincial deficits added to the strain. Tax collection lagged projections. Instead of adjusting the exchange rate to regain competitiveness, authorities financed shortfalls through borrowing. External debt rose from roughly 30% of GDP in the early 1990s to above 50% by the end of the decade. Every new bond issuance assumed the peg would survive. Every rollover required continued access to capital markets. As long as capital flowed, the contradiction stayed dormant. Reserves appeared sufficient. Banks remained liquid. Depositors stayed confident. But the system had no elasticity. If growth slowed, revenues declined. If revenues declined, borrowing increased. If borrowing increased, debt ratios worsened. If debt ratios worsened, investors demanded higher yields. Higher yields increased fiscal strain further. Feedback loop, compounding. The peg removed the visible shock absorber. Normally, a weakening economy would see its currency depreciate, exports become cheaper, and trade balances adjust. Under the currency board, that adjustment channel was sealed. The exchange rate could not move, so wages, employment, and output absorbed the strain instead. Adjustment shifted from price to balance sheet, and balance sheets store stress. When emerging market crises hit in the late 1990s, Mexico, Asia, Russia, global capital became more cautious. Risk spreads widened. Argentina's borrowing costs increased. Growth slowed. Unemployment climbed above 15%. The exchange rate remained 1-to-1. The rigidity did not soften. The arithmetic did not pause. To defend the peg, policymakers tightened fiscal policy. Spending cuts, tax increases, higher interest rates. These moves reassured creditors temporarily, but they also reduced domestic demand, shrinking the tax base further and increasing the debt burden relative to GDP. Defend the peg. Increase the debt load. The contradiction intensified. Artificial stability suppresses volatility, but it does not eliminate imbalance. It delays recognition. It channels pressure into slower-moving variables. debt accumulation, reserve dependency, declining competitiveness. 10 years of one-to-one parity trained households and businesses to assume permanence. Bank deposits became increasingly dollar-linked. Real estate transactions referenced dollars. The domestic currency functioned less like an independent instrument and more like a certificate backed by external reserves. The longer the peg held, the less imaginable its failure became, and the more debt depended on its survival. By the end of the 1990s, the structure was clear: a rigid exchange rate, rising external debt, slowing growth, fiscal strain, reserve dependency. None of these variables had exploded, but they were converging. Artificial stability was intact. Underneath, liabilities were compounding. Pressure was being stored, not resolved. That stored pressure is the transition point into Stage 2, where imbalance stops being hidden and begins to surface in measurable depletion. Stage 2 begins when stored pressure becomes visible on the balance sheet. The exchange rate is still fixed at 1-to-1, but the liabilities are rising faster than the economy supporting them. By the late 1990s, Argentina's growth rate had slowed materially. Output decelerated. Tax revenue softened. Yet debt service obligations continued expanding because prior borrowing had been locked in at dollar terms. The peg did not move. The debt did. Public debt climbed from roughly 30% of GDP in the early 1990s to above 50% by the end of the decade, moving toward 60% by 2001. Each percentage increase meant larger interest payments. Larger interest payments meant larger primary surpluses were required just to stabilize the ratio. Those surpluses did not materialize. Arithmetic widened. Under a currency board, reserves function as hard collateral for the monetary base. Every peso issued requires dollar backing. That means the liability side of the central bank's balance sheet is fixed in exchange rate terms, while the asset side depends on reserve adequacy. If reserves stall while debt grows, the coverage ratio deteriorates. Quietly. Through 1998 to 2000, capital inflows slowed sharply after global emerging market crises. Investors demanded higher spreads. Argentina's growth slowdown made its fiscal position look weaker relative to peers. Reserve accumulation stalled. Debt expansion did not. Mismatch. The structure was now asymmetrical. External liabilities rising in dollars, reserves no longer compounding at the same pace, and a domestic economy contracting under fiscal tightening. The peg remained intact, but the buffer was thinning. Higher risk perception translated into higher bond yields. Spreads widened above 1,000 basis points at points during the crisis buildup. Each refinancing cost more than the last. Interest expense absorbed a growing share of government revenue. Interest became structural. Because the exchange rate was fixed, Argentina could not use depreciation to restore competitiveness. Adjustment had to occur internally, through wage compression, spending cuts, and output contraction. Contraction shrinks GDP. Shrinking GDP raises the debt ratio even if nominal debt is unchanged. Ratio pressure intensified. Austerity measures were introduced to defend credibility. Spending cuts, tax increases, commitments to fiscal reform. These steps were designed to stabilize debt dynamics and reassure lenders. But austerity in a declining economy compresses revenue further. Revenue falls. Borrowing rises. The peg still holds. But the gap between promise and capacity widens. Now integrate the clock. Historically, fiat systems last decades, not centuries, often averaging around 27 years across multiple studies. Argentina's currency board regime began in 1991. By 2001, it had been operating for roughly 10 years. 1 decade in. Mid-cycle pressure, not ancient. The U.S. dollar severed its final gold link in 1971. That anchor removal is now measured in decades as well. Time compounds design flaws. In Argentina's case, the first decade of the peg delivered credibility and capital inflows. The second half of that decade delivered slower growth, rising debt, and reserve dependency. The clock was not theoretical. It was balance sheet-based. Each year of subpar growth reduced fiscal elasticity. Each refinancing increased sensitivity to yield spreads. Each reserve drawdown narrowed the coverage margin. Coverage thinned. Debt stacked. Reserves mattered more. Structural imbalance is not a narrative. It is a ratio problem. Liabilities denominated in dollars. Assets dependent on inflows. Growth below debt cost. By 2001, the three variables were aligned in the wrong direction simultaneously. Rising debt ratios, slowing growth, and reserve stagnation. No shock required, just convergence. The peg still displayed stability at the surface. 1 peso equaled $1. But underneath, rollover risk was compressing time. Capital moved faster than policy. Spreads widened faster than reforms could close gaps. The intervals shortened. Funding windows tightened. Confidence became conditional on continuous improvement that the economy could not deliver quickly enough. When a rigid exchange rate regime meets accelerating rollover risk, the next constraint is not theoretical sustainability. It is liquidity, and liquidity breaks faster than solvency. Stage 3 begins when solvency concerns convert into liquidity constraints. The imbalance is already visible. Debt ratios are elevated. Growth is weak. Reserves are under pressure. But the exchange rate still reads 1-to-1. Then access changes. In late November 2001, the government imposed what became known as the Corralito, a restriction limiting cash withdrawals from bank accounts to 250 pesos per week per person. Not a devaluation. Not yet. A withdrawal ceiling. The official explanation was stability protection. The mechanical reason was simpler. Depositors were converting pesos into dollars and withdrawing physical cash. That behavior reduced bank liquidity and drained reserves simultaneously. Banks operate on fractional reserves. They cannot satisfy all depositors at once. Under normal conditions, that is not a problem because withdrawals are staggered. Confidence prevents simultaneity. Confidence shifted. When depositors suspect a peg may fail, the rational incentive is to withdraw early. If 1 peso equals $1 today, but might equal less tomorrow, conversion timing matters. First movers preserve parity. Late movers absorb adjustment. Incentives flipped. Withdrawal requests accelerated. Dollar deposits moved abroad. Reserve pressure intensified. The central bank could not expand liquidity freely because every peso required dollar backing. Liquidity was finite. And finite liquidity meets infinite claims. The government's choice set narrowed. Either allow unrestricted withdrawals and risk a full banking collapse, or restrict access and preserve reserves temporarily. They chose restriction. The Corralito capped withdrawals at 250 pesos per week. Electronic transfers within the banking system were allowed, but cash access, the ultimate settlement instrument, was rationed. Access became conditional. From a balance sheet perspective, nothing had changed about nominal account balances. Depositors still had their pesos. But the liquidity profile of those balances had changed dramatically. Money that cannot be accessed is not functionally equivalent to money that can. Liquidity defines value. Under the peg, banks held dollar reserves and peso liabilities. If too many peso liabilities were converted into dollars at once, reserves would deplete rapidly. Once reserves fell below coverage thresholds, the credibility of the currency board would fracture. Restriction was an attempt to slow the conversion. Time purchase. But time is expensive. The imposition of capital controls signals that the system cannot meet simultaneous claims at the promised exchange rate. That signal changes depositor psychology further. Even those who were patient begin recalculating incentives. If access is capped at 250 pesos per week, large balances become trapped. Businesses cannot meet payroll. Suppliers demand alternative payment. Informal markets begin pricing risk into transactions. Parallel exchange rates emerge. When liquidity is restricted, price discovery migrates. The peg remains official. But market perception diverges. The arithmetic becomes suffocating. A depositor with 18,400 pesos can withdraw 250 per week. That is 73 weeks for full access, more than a year. Time stretches. Under liquidity restriction, the banking system shifts from maturity transformation to containment. Its role becomes preventing exit rather than facilitating flow. Credit contracts. Economic activity slows further. Tax revenues decline further. Debt ratios worsen further. Restriction does not solve imbalance. It freezes it. The mechanism is mechanical. A fixed exchange rate with declining reserves cannot survive a full-scale bank run. Therefore, access must be limited to prevent reserve exhaustion. Banks must freeze because they cannot print dollars. The central bank must restrict because it cannot create unbacked pesos without breaking the currency board law. Incentives leave no middle ground. Allow exit, lose reserves rapidly. Block exit, lose confidence gradually. Both paths compress time. Liquidity crises move faster than solvency crises because they are driven by coordination. Once enough participants act simultaneously, the system shifts phase. Phase shift. During the Corralito, protests escalated. Economic activity contracted sharply. Informal dollar markets expanded. The official parity remained, but effective parity weakened in practice. Liquidity restriction marks the transition from structural imbalance to systemic fracture. The peg is still declared intact. But access to the currency is rationed. When a monetary system must restrict its own unit of account to preserve credibility, the structure is already compromised. The next step is no longer about access. It becomes about repricing. Stage 4 begins when the constraint fails. Liquidity restriction slowed withdrawals, but it did not rebuild reserves. It did not reduce debt ratios. It did not restore growth. It only delayed reserve exhaustion. By December 2001 and early 2002, the one-to-one peg was abandoned. The currency board framework ceased functioning. The peso was allowed to float. The exchange rate repriced immediately. Within months, the peso depreciated by roughly 70% against the US dollar. 1 peso per dollar moved toward nearly 3 pesos per dollar. Nominal balances remained unchanged. Real purchasing power did not. This is the mechanical correction. Under the peg, liabilities were structured around a fixed parity that reserves could no longer support. Once reserves proved insufficient relative to outstanding claims, the exchange rate adjusted to reconcile the imbalance. The repricing transferred loss. Dollar-denominated debts expanded in peso terms overnight. Firms with foreign currency liabilities saw debt burdens multiply relative to domestic revenue streams. Households holding peso savings experienced a sharp decline in international purchasing power. Savings absorbed the adjustment. Inflation accelerated as import prices recalibrated to the weaker currency. Contracts indexed to domestic prices adjusted upward. Real wages compressed. Asset valuations were reset to reflect the new exchange rate level. The adjustment was asymmetric. Those holding foreign currency assets were relatively insulated. Those holding domestic cash balances bore disproportionate loss. Entities with dollar liabilities faced solvency stress. Balance sheets cleared through redistribution. The counterintuitive insight is this. Currency collapses frequently occur after extended periods of stability. The explanation is structural. Prolonged exchange rate rigidity suppresses small, incremental adjustments. Competitiveness gaps widen gradually. Debt accumulates under the assumption of parity permanence. Reserve dependency increases as the system relies on continuous inflows. Adjustment is deferred. Deferred adjustment increases stored imbalance. When the anchor finally breaks, multiple accumulated distortions are repriced simultaneously. Exchange rate, wages, asset values, and debt burdens. The magnitude of the reset reflects the scale of prior rigidity. Under a floating regime, exchange rates move incrementally. Under a fixed regime, imbalances accumulate in quantities rather than prices. When price flexibility returns, quantities reprice in a compressed window. The outcome in Argentina followed this structure. After the devaluation, exports became cheaper in foreign markets. Trade balances improved over time. Growth resumed in subsequent years, but competitiveness improved only after loss recognition. The improvement was conditional on purchasing power destruction, debt restructuring, and balance sheet contraction. The reset restored price alignment by reducing the real value of domestic claims. Repricing was the mechanism. Stage 4 is not discretionary policy. It is the mathematical endpoint of an unsustainable coverage ratio between reserves and liabilities. When the claim structure exceeds the collateral base and liquidity restriction cannot restore confidence, the exchange rate becomes the clearing variable. No rhetoric required. If liabilities grow faster than reserves and growth fails to offset the divergence, the fixed price cannot hold indefinitely. Once the constraint breaks, repricing equalizes the imbalance through currency depreciation and purchasing power adjustment. The sequence is mechanical: fixed anchor, accumulating debt, reserve strain, liquidity restriction, repricing. The reset closes the gap between nominal promise and balance sheet capacity. And once that gap is closed through devaluation, the prior regime is finished by arithmetic, not by narrative. Reconstruct the sequence. A fixed exchange rate installed in 1991. A decade of apparent stability, rising external debt, reserve dependency, liquidity restriction, then repricing. Argentina's currency board lasted roughly 10 years. Historically, fiat systems tend to last decades, not centuries. Multiple monetary studies place the average lifespan of fiat regimes at approximately 27 years before structural redesign, reset, or replacement. Not infinite, time-bound. The constraint is not political, it is mathematical. Every fiat structure rests on three variables: the growth rate of liabilities, the growth rate of productive output, the credibility of collateral backing the unit of account. If liabilities compound faster than output, debt ratios rise. If debt ratios rise faster than confidence, borrowing costs increase. If borrowing costs rise faster than revenue growth, rollover risk compresses. If rollover risk compresses faster than reserve accumulation, liquidity tightens. If liquidity tightens while the exchange rate is fixed, access must be restricted. If access is restricted and reserves continue to thin, repricing becomes the clearing mechanism. No ideology required. Just sequencing. The structural countdown is embedded the moment rigidity replaces flexibility. A fixed anchor removes incremental adjustment. Debt fills the gap. Reserves become the buffer. When the buffer shrinks relative to claims, the regime moves from imbalance to restriction to reset. Different countries have different triggers. The mechanics do not vary. Fiat systems are elastic only if they can reprice gradually. When they suppress repricing for extended periods, they store imbalance in quantities rather than prices. Quantities compound. Eventually, price adjusts. The timeline is not measured in headlines. It is measured in ratios: debt to GDP, reserve coverage, interest to revenue, current account balance. When those ratios diverge persistently, the structure compresses. Not emotionally, arithmetically. Argentina did not collapse because of chaos. It repriced because liabilities outpaced support. That is the template. Currencies do not fail because people panic. People panic because the numbers no longer reconcile. Currencies do not die from noise. They terminate when claims exceed collateral. Currencies don't die from chaos. They die from arithmetic. Comment: Stage 1 if you recognize artificial stability where you live.